All right, class, we're continuing in part 3, the financial aspects of merchandising. So let's talk about merchandising accounting. So in this chapter, we'll explore the different financial statements used in accounting that provide insight into the health of an organization and allows for informed economic decisions. The four financial statements. Organizations report four distinct financial statements that show the results of their economic activity. Financial statements have an interrelationship. While they each report on a specific type of economic activity, the same underlying transactions affect all four. Hence, all four must be considered when making business decisions. These reports are generally prepared in the order listed on the slide. So your income statement reports the results of business operations over time. It shows profit performance. Your statement of shareholders' equity discloses the change in the owner's business interest over time, such as a year. Your balance sheet reports an entity's financial position at a single point in time, such as the last day of the business year. So this essentially shows your assets, liabilities, and owner's equity. Your statement of cash flows reports the net increase or decrease in cash during a reporting period. It shows the balance of cash going in and coming out. The balance sheet is a statement of an organization's assets, liabilities, and owner's equity at a particular point in time. Your assets are the things that are owned by the organization. It can include cash, inventory, and store fixtures. Assets are classified according to their liquidity, which pretty much means their conversion to cash. So short-term assets are converted to cash within a year, while long-term assets are not converted to cash within a year. Your liabilities are your debts that are owed by an organization. These are classified according to the time in which they are due to be paid. Your short-term liabilities are due within 1 year. These include payments to suppliers and lending institutions. Your long-term liability is due in 1 year or longer. These include mortgages on the land and the building, and the long-term financing for extensive expansion and renovation projects. So here's an example of a balance sheet. Financial ratios are analytical tools based on the relationship between two balance sheet components. They assess an organization's level of solvency or financial stability. A current ratio is the relationship between current assets and current liabilities. A current ratio measures an organization's short-term debt paying ability or ability to pay off current debts within current assets. A current ratio less than 1.0 indicates that current liabilities are greater than current assets and that current sales are insufficient to pay off current liabilities. A highly undesirable financial position. A 2.0 current ratio indicates that the current assets are twice current liabilities. Financial ratios are also important factors. A factor is a financial intermediary peculiar to the apparel industry that assumes responsibility for collection of manufacturers' receivables from retailers. Factors purchase receivables at discounted rates from manufacturers to cover the costs and financial risk associated with collecting them. Factors keep a watchful eye on the fiscal status of retailers and will refuse to approve shipments to stores whose financial statements tend to signal the inability to pay promptly. So let's take a look at the formula for financial ratios. It's current assets divided by current liabilities. Your statement of cash flow is the balance of cash coming into and going out of an organization. When cash flow is positive, more cash is coming into the business rather than going out. But when cash flow is negative, more cash is going out of the business rather than coming in. At time, cash flow can be balanced, pretty much leading to a wash. A positive cash flow is always preferred. So, when cash flow is negative, how can this be resolved? Retailers resolve this with short-term borrowing, which is pretty much taking out loans to enable them to pay for their financial obligations to suppliers. A positive cash flow can be enhanced by scheduling the delivery of goods as close as possible to their point of sale and by negotiating payment terms that delay payments to suppliers as long as possible. Looking at the graph, a positive cash flow is any point where the cash in line is higher than the cash out line. A negative cash flow is any point where the cash out line is higher than the cash in line. And a balanced cash flow is represented by points on the graph where the cash in and cash out lines coincide. Income statement. The income statement, also referred to as a statement of earnings, statement of operation performance, or a profit and loss (P&L) statement, shows an organization's profit performance over a period of time. There are four components: revenue, expenses, net income, or loss in earnings per share. Revenues increase assets or settle liabilities through selling goods and rendering services. In retail, sales make up the business's central business of activity. Expenses are the cost of doing business or the resources needed to make sales or provide service. This includes the building, staff, merchandise, and fixtures. They decrease assets or increase liabilities. Net income is the difference between gross margin and expenses. A profit results when expenses are less than revenue and the net income is positive. A loss results when expenses are greater than revenue and net income is negative. Earnings per share reports the amount of net income or another measure of income earned by each share of stock during a reporting period. Let's take a look at a formula. So in order to find out what your net income is, you would take your revenue and subtract your expenses. Now with income statements, there's also 5 major components specific to retailers: net revenue, cost of goods sold, gross margin, expenses, and net income. In the previous slide, we discussed net revenue, expenses, and net income. So let's discuss the cost of goods sold and gross margin. The cost of goods sold includes the build cost of merchandise plus shipping and workroom costs, less cash discounts for early payments and returns to vendors. Gross margin is the difference between sales and the cost of goods sold. Retailers rely on gross margin to cover operating expenses and ultimately profit. So buyers can maximize gross margin by negotiating good prices with vendors, hence maintaining a low cost of goods sold. Also, managing retail prices to maximize net sales. Net income is the difference between gross margin and expenses. Net income can be increased by increasing sales and increasing gross margin, decreasing the cost of goods sold, decreasing expenses, or any combination of the above. Net sales are equal to gross sales minus customer returns. High net sales show the merchandise selection is appealing to the store's target customers. High customer returns indicate poor merchandise selection, poor product quality, or poor fit. So there's a few different formulas related to the major components of the income statement for retailers. So in order to determine what your gross margin is, you would take your net revenue and subtract the cost of goods sold. You can also figure your net income in terms of loss as well by then subtracting your expenses from your gross margin. To determine what your net sales are, you will take your gross sales and subtract your customer returns. So continuing with our income statements. So you also have the formula for cost of goods sold. And that formula is taking your billed cost of merchandise, adding your shipping costs, adding your workroom costs, subtracting your cash discounts, and subtracting your return to vendors. So your shipping costs are going to be those inbound delivery costs from transporting goods. Your workroom costs are going to be the activities to prepare the merchandise for sale. Your cash discounts are going to be invoice concessions from suppliers for prompt payment, and your return to vendors are going to be your chargebacks to vendors for defective or so-selling goods returned for credit. Component percentages is a ratio of an income statement component expressed as a percentage. Such components as gross margin, expenses, or net income to sales. Component percentage evaluates performance between two time periods referred to as a time series comparison. So to calculate your cost of goods sold percentage, you would take your cost of goods sold divided by your net sales and multiply it by 100. To determine what your gross margin percentage is, you would take your gross margin, divide that by net sales, and multiply it by 100. To determine what your expense percentage is, you would take your expenses, divide that by net sales, and multiply by 100. For your net income percent, you would take your net income divided by sales and multiply by 100. Your gross margin return on investment, or GMROI, creates a single measure of performance by integrating two performance measures, gross margin and turnover. It measures the amount of gross margin dollars generated per dollar of average inventory invested. Typically, a high turnover and high gross margin yields a high GMROI, and a low turnover and low gross margin will yield a low GMROI. Maximizing GMROI is a major goal for buyers because high turnover and high gross margin are desirable merchandising objectives. To calculate GMROI, you're going to take your gross margin dollars divided by your net sales, and you're going to multiply that by your net sales divided by average inventory. This formula can also be simplified by canceling out the net sales. So you can essentially take gross margin dollars and divide that by average inventory and get your GMROI as well. All right, class, this ties up Chapter 10, Merchandising Accounting.